And the sound of that for a song means that we are at the halftime report. Today is Tuesday, December 7th, 2021. Welcome out, everybody, to another edition of the halftime report. I am Coach M, joined by our fearless leader, Coach Matt. We're going to talk markets. Markets are starting to recover and just rocking and rolling today. Matt, how are you doing this afternoon or this morning, rather, where you are?
I am doing absolutely fantastic, and I am definitely not as good as this market is. I mean, you're talking about a breakout against 4,600. The intraday is starting to build, and apparently there's no new variant. So let's go.
I was going to ask you if you're doing better than the market, so the market is doing better than you are today.
I think the market is doing better than everybody.
Okay.
Yeah.
And if the market's doing better than everybody, then hopefully everybody else is also having a good day in the market because
Yes.
there's a lot of opportunity there today. We're going to talk all that, all things market. But let's do what we always do, get into the market recap and look at the S&P and go through the other indexes. What are you
Well,
seeing in the S&P?
yeah, I think as we get into Monday, we do a little bit of a deep dive on the technicals of the marketplace from a broad-based market perspective, and we spent quite a bit of time on those technical parameters that we were looking at yesterday as this market was trying to fight for its recovery, and we identified a couple levels intraday that were very interesting. And as you can see, the double bottom starts to play out here over the last couple days. The 4,500 handle starts to double bottom as we discussed yesterday. Top level, you're really kind of looking at that 4,600 level that we discussed yesterday as well. And then basically what we were talking about yesterday is if this market is going to recover, it's got to break out of that yin and yang over the daily price action where you have one day up, one day down, one day up, one day down, and you really can't find your foundation that you can start building upon. And yet that's what we're starting to see here today. And so I do think it's important to kind of update this from a technical perspective. When you're looking at the price levels that we discussed yesterday, we discussed 4,600. You saw the breakout yesterday as we were talking, a little bit of a retracement. And then the second level we talked about yesterday was that 4,650 level. And that 4,650 level, as you can see right here, starts to kind of come into focus early in the morning here before the strong cash open that you saw here just a few hours ago. You see the consolidation right there around that 4,650 level. And that consolidation was right in that 20 period moving average that we discussed yesterday as well. And if this market was going to, not be one of those fake out scenarios, and again, we got to see a close here, but you got to appreciate kind of what the market is doing as it's building back up into that 20 period moving average. It reclaimed the 20 period moving average. It beat back up against the 9 EMA. It reclaimed multiple different horizontal resistance levels on an intraday chart. And I do think as we discussed yesterday, when you're looking at the combination of the double bottom here at 4,500, the double top in that 4,600 range, and then the trend line that we broke through yesterday as well. When you look at this trend line on the hourly chart, you can connect the peaks there. That trend line comes down, down, down. You break out of that trend line yesterday. That's a nice little flag-based pattern as you're breaking out. You got the double bottom. And then once you start reclaiming everything, what happens? And the media is going to paint this as a melt up is how they're going to paint it because that's how they paint technical analysis. But the simple reality is once you start breaking a lot of these patterns, the market starts to walk up the stairs from an intraday perspective because all of a sudden these old resistance levels, they now start acting as a little bit of support. And so you start seeing that series of higher highs, higher lows, higher highs, higher lows. And it starts building a little bit of confidence in the market as you start looking at this technically. You now see this as a nice consistent bullish uptrend from an intraday perspective, whereas what you were looking at here was a very, very big choppy mess of volatility. And I wouldn't say the volatility is subsiding. Volatility works both up and down. You really haven't seen volatility subside yet, but you are starting to see that bullish mentality start to come back in. The consistency on the bullish side is coming back in, and a lot of charts are messy right now. There's no doubt about that, and they're messy because the volatility over the last week and a half, 2 weeks has been really, really extreme. It's going to take a little bit of time for those charts to get a little bit more consistent. But from a major market perspective, I do think you got to like what you're seeing here from a bullish perspective in the reclaiming of 4,600 technically, getting back up above the 20 period moving average. And even though the daily charts, once again, you're looking at a little bit of a choppy mess here from a daily perspective, you don't have that consistency that we're looking at in a build, but you're certainly seeing the early beginnings of the consistency from an intraday perspective that can build into a more consistent trend. And so, it's we talked about it a week ago when we were first started talking about Omicron, and we talked about that wall of worry, right? That remember the wall of worry back September, and how that wall of worry just started pushing the market down, 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 down. But as we knocked, and I mean we as the general we, right, the market participant we, as we knocked down those pegs, right, the wall of worry starts to dissipate, the confidence comes back a little bit in the marketplace, and the worry this time around, because we were so close from a time frame perspective against what happened with Delta. Remember, Delta was just a few months ago. It was this massive concern that absolutely had an impact on the economy. And so that's still in the back of the minds of all the traders in recent history going through the price action that Delta did represent. And so there was obviously some understandable reasons for concern when Omicron came to the marketplace about a week and a half ago now. But if you'll remember back last Monday, Coach Mark was on the halftime report and he was saying, you know what, listen, there's reason to worry here, but we need to give this a little bit more time. And all last week, Coach Mark did a wonderful job coming to the halftime report and talking to our community about the things that he is seeing. And like what a lot of the market is finally waking up to is Omicron is not Delta. And it's not Delta in the sense that, yes, it has a higher transmission rate, and that is cause for some concern, but it also has, so far, less severe illness, less hospitalizations, and everything less that the market is concerned about. And so as that worry that Omicron represents to the global economy, to the shutdowns, to everything that goes along with the pandemic, as that starts to dissipate, the market responds back to the bullish environment. And so when you look at it from a price action perspective, we're basically back to where we were before the volatility began. And now we're talking about navigating this potential breakout in the marketplace against an all-time high. And so I do think it's reason to, I don't think it's time to celebrate in the market, no doubt about that. As a bull, I think we got to build on this momentum, and that building on this momentum is very clear to me. The resistance zone right there north of 4,700. You're right there in that ballpark range of that 4,720 type breakout. And so if this market is going to build on the consistency, you're going to want to see a little bit of consolidation over here to the right side of this chart. You're going to want to see that consolidate at a price level that is slightly higher than the 20 period moving average. You want to build into strength is my point. You want to continue to build into this. And so those charts do get a little bit more consistent, but so far so good. We're broken out of the pattern.
Yep.
The pattern was that choppy up and down, yin and yang technicals that we were dealing with in the market. You've broken out of that. You now have 2 consecutive days of price appreciation where you're finishing towards the highs, and that's a positive development for the market as well. And so I don't think we're out of the volatility. I don't think we're necessarily outside the yin and yang to a certain extent. But as that wall of worry dissipates, the market does get a little bit more consistent, and so far so good.
Yeah, and I think the confidence starts to come in, because we held the 50. Yesterday was a good day. We stayed above the 50. That's been, a known level where we see buyers coming in over.
It is the buy the dip. The 50-day moving average is.
So yesterday holding, and then today's strength really is starting to, we're not pushing all the chips in, but we're like, okay, I might, throw a little bit of something in on the bullish side, but definitely not all in quite yet. Wait for the messiness to kind of, come to an end, and then start to assess. But there's definitely a lot of opportunity in the market as we speak. A lot of them did gap though. That's the thing was like when the market does have a recovery and you get this big type of days, Then all your trades that you kind of had, maybe they were higher basing, then they break out and then you miss the entry. How would you adjust those entries when you get a break? Like if somebody was looking at the S&P, the ETF
Yeah.
instead of the markets, and you wake up in the morning and you've got this huge gap where you're potentially looking to get in, how would you look into assessing now on a intraday level, and where you would start to look at the S&P in terms of trading it, if that was something that somebody wanted to do?
Well, the number one trick to smooth out the volatility is actually to extend the time frame. Is
Mhm.
to kind of instead, if you want to smooth out the choppiness of the last couple weeks of price action, you just kind of switch this out to a weekly chart, and it will smooth out that volatility really well. And so when you're looking at kind of, let's say the S&P is you're looking at this as a trade type scenario, and you're like, okay, I like the price action here, right? I like the upward movement in price. I like the bounce off the 20. I like the kissing off the old resistance zone, which is acting as a new support zone. But the trigger would absolutely have to be above the previous high. And so when you're looking at that, you got a pretty safe 472 zone that you kind of track there. And so you're saying, okay, I like everything that's been building here, but any new trade would have to be above the high here, and you'd have to see a breakout, in my opinion.
Awesome. Excellent. All right, let's take a look at the other markets. Let's take a look at the Dow Jones. That one got beat up a little bit more, but made it a recovery after bouncing off the 200.
Yeah, I mean, again, a little bit of a deeper correction, but once again, it was the upward movements in price on the Dow was not the same. It was not the same as the upward movements in price on the S&P, and so those downward movements in price are going to look a little bit more choppy here as you're coming into the 200-day moving average. But the simple reality is you got the same type of build you're looking at here as you're looking at the S&P. And again, I'm not necessarily seeing a volatility shift here, which is I do think is needed for the marketplace. I'm seeing the continuation of the same volatility, but again, it's more on the bullish side than the bearish side, which is typically a positive development. And so you gotta like it, and you like it for the exact same reasons. You like the S&P 500. It's reclaiming the moving averages. You're seeing a bullish environment where you're finishing towards the highs. You're breaking out of previously known resistance areas on the Dow Jones. The very important number is going to be 35,500. You're reclaiming that level of old resistance. You see the double top over here. You see the kiss of support. It tried to act as support before the blow up due to Omicron. You saw that volatility pick down. Now you're reclaiming, and you're basically back to where we started this entire storyline on Omicron. And so you got to like the development here, but you are going to be fighting through some pretty important chop there around that 36,000 level. It's not necessarily as clean as what we're seeing on the S&P 500, with the S&P 500 kissing up against the old resistance breakout. You break out of that level, you got some clear error here on price appreciation. I don't necessarily have the same opinion on the Dow, because once again, you break out, you're still staring at an all-time high. I do think the Dow's got a little bit of work to do before it gets as clean as the S&P on that breakout. And then when you're talking about potential breakouts, you got to be talking about the NASDAQ as well, as the NASDAQ's up against a pretty important resistance zone right there around that 16,440 level. And then in the Dow, in the final index here, you're talking about the Russell 2000. And unfortunately, as the deep retracement never got gobbled up, it just broke too many things. And quite frankly, it needs to reestablish technical parameters. And we need to get back into that mindset. Okay, we know the numbers, 2,300. We know the numbers, 2,350, 2,100 on the downside. This is back into neutrality for me. And until we get back above 2,300, I still think you're back into the range on the Russell.
Well, you know what I like to say, the bird is back in the cage, so let's keep on cash flowing.
Yeah, those condor trades, like, yeah, we know the protocol. We're good.
Back in the
Uh,
cage. Nothing to see here. Let's I think even though you guys did an obviously a very wonderful deep dive into the sectors yesterday, with the market moving the way it is today, why don't we do a quick roundup on those sectors and see if we have anything to update the people?
Absolutely. And on a day like today, I do think it's important to update from a technical perspective of what we are seeing in the sectors. Again, when volatility hits the market, markets have a tendency to move with one another because fear and greed drives every index the exact same way. So it does take a little bit of time before the market does start to separate itself, and you can really start to see where that money is flowing into the sectors from a sector rotation perspective. And so when you're in these moments, I do think it's a little bit more important to really spotlight those sectors. And so let's take a quick peek just to update from a technical perspective what we're seeing in the sectors. Let's start with the worst sector just to get it out. This is still a bearish retracement. It still has not yet tested the 20-period moving average.
Yeah.
And so we're still looking at it in communications as a bearish retracement. I see communications being carried by the market, not carrying the market. And that's typically not a position you want to be in. You want to buy into strength and you want to sell into weakness. Right here, the not the Russell, but the communication sector, it is a dog. It's been a dog. And until we see a double bottom here, I don't think there's anything to see on the top side. And if comms wants to V-shape, good on comms, because as market participants, that's going to be beneficial to everybody. But I'm not going to be a player here on the bull side. I got this as a bearish retracement that has a little bit of slowing momentum in candle. As you can see, the market gapped up today, but it didn't run up. It gapped up on the strength of the marketplace, not on the strength of itself. And so you would like to see a little bit more bullishness after the cash open, because the cash open was extremely strong. A lot of the price movement we're seeing in comms is simply due to the Asian markets and the European markets that had a very good trading session. And obviously the pre-market activity obviously helped as well. And so I just want to quickly update that as we do navigate that bearish retracement. When you're looking at, yeah, go ahead.
So remember Verizon's old slogan, can you hear me now?
Mm-hmm.
So if we categorize, comms all as Verizon, we still can't hear them, right? They're still
no. I can you hear me now? No, I can't even see you. Like
Yeah,
where? I can't even see you. Like where are you? No, I'm with you on that. I'm with you on that.
Call me when you get to 80. Maybe we have a conversation when you get to 80. Maybe we claim that old support zone at 80. We'll have a conversation then. Communication.
100%. And I do think I'll be able to see and hear communications at some point. But it is not when it's having an increasing bearish trend to the downside with a bearish retracement from a technical pattern. I think there's better opportunity to pick up weaker stocks with double bottoms. And so I do think there will be an opportunity here in comms. It's just let the technicals work themselves out. Let the time pass that needs to pass for this to shift its trend, for it to shift its pattern. Because right now, I don't see personally, I don't see anything of any bullishness within the communication space until we start seeing some degree of double bottom, slowing momentum and trend, something along those lines. When you're looking at discretionary here, XLY, discretionary's got work to do. It just does. And don't get me wrong, you got to like the fact that 200 held. You got to like the fact that the 50-day moving average held as well. But when you look at this choppy mess, it is absolutely a choppy mess. It's very difficult right now in the discretionary space to get an accurate and a good read on exactly where this sector really wants to go. And a lot of it is due to Tesla. A lot of it is due to the volatility that Tesla represented. A lot of it is due to this space going ham for an entire month and a half of nothing besides up, 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 up. And so you're looking at a very choppy range of neutrality here. And for me, it's just simply got a little bit of work to do before you really see some confidence build in the discretionary space. And then when you look at technology, if you want to talk about a path to recovery to where you will get some confidence in the aggressive areas of the market, I do think it has to be technology here. The NASDAQ kind of gapped up, is showing some strength here today. When you're looking at the technology sector, that is obviously primarily, NASDAQ components, you're talking about a potential breakout here. And again, it's very volatile. It's very choppy, but technology did held up a lot better than some of the other sectors did. Technology held up better than discretionary did. It doesn't have the same type of volatility in it that, say, discretionary does. and it certainly held up a heck of a lot better than communication space did. And so when you're looking at this on a weekly chart, I do think you've had enough time to look at this as a little bit of a high base scenario on the weekly chart. And so when you're looking at the weekly chart here on technology, I do think you see a little bit consistency, and a breakout here could see some price appreciation. And so in the aggressive areas of the market, comms just it has some work to do. Discretionary has some work to do. With communications, it's all about looking for double bottoms. It's all about looking for slowing momentum. In discretionary, it's waiting for the volatility to subside, quite frankly. Letting a little bit of time in discretionary pass will certainly help smoothing out that volatility. But when it comes to technology didn't have the downward movements in price that comms did, and technology did not have the volatility skew that discretionary had. And so I do think the confidence rating, if you were to rank this out of 10, I do think the confidence in technology or the technology technical analysis is significantly higher than what you're seeing in discretionary, and definitely what you're seeing in communications. Now, when you're talking about the cyclical areas, I do think you got to really kind of start with the industrials, with energy, with basic materials. And when you're looking at the energy charts here, and again, let's start on the daily chart here. I do think it's important here, but you did reclaim those moving averages. Look at the cluster of the 20 and the 50 right there, acting as a little bit of support level. It's volatile, but everything has been volatile in the market recently. But a couple things I really do like here on the energy space. Number one, you reclaimed all the moving averages. That's number one. And number two, when you're looking at that little trend line right there, you reclaim that trend line. And when you reclaim that trend line, typically what's going to look like, that's going to look pretty decent on a weekly chart. As you're looking at that 200-day moving average on the weekly chart, acting as an old new support to an old resistance right there at about 56. And so I do think you're looking at this a little bit more positive, given the fact that you are breaking back up above that trend line. You're reclaiming all the moving averages there as well. So energy looks to be a little bit in the spotlight, and up about 3% on the day. Materials up another 2%. Materials chart, the one you're looking at, is this snapback on the weekly. Look at that 3-day pullback on the weekly coming into old resistance. It did break that, technically it did, but it recovered fairly aggressively and fairly quickly. You got to like that from the weekly perspective. That looks like confirmation against the previous trend here. Overall, you're looking at a neutral pattern from a weekly perspective. I look at a little bit of scaling in here, actually, in materials. I like the breakout. I like the confirmation on the retracement on the weekly. And then you got a very easy trigger to add to it once basic materials does reclaim 90. And so you're looking at an environment in materials that could get very consistent very quickly. And I do like the weekly confirmation here, very similar to what we're seeing in the industrials, very similar to what we're seeing in the energy space. But to me, it's really about weekly retracement, getting back up above the weekly channel. You're looking at that as confirmation. And then $90 here is obviously a target to where if you break up above 90, you know what they say when it breaks above 90. And what do they say? What do they say? I don't know who says that, but what do they say? When it breaks 90, it goes to 100. 100% of the time, right? We say that tongue in cheek to a certain extent, but I do like the build here on a weekly perspective, and I do like it. If it gets above 90, I think you got a little bit of clear air, and whether or not you get to 100 or not, I doubt it in one move. We're talking about a sector, not a stock here, and a sector to go 10% is a vastly different thing than a stock going 10%. And so I don't think we can be like, oh, swing trade 90, go to 100 in materials. No, that means like everything in materials went up like 30%. That's not probably going to happen. And so I do like it here. Again, you got to like it because it reclaimed a lot of resistance areas that were important. And again, you're looking at that 90 handle as a retrigger above that in the material space. Industrials, very similar to the conversation we had in materials. The difference is the sell-off was a little deeper and the drive up was not as good. which means you're back into neutrality into some degree of industrial. You got to like the weekly confirmation, but again, you're still stuck underneath some pretty important resistance levels. And so I do think you like what you're seeing here, but it's got to break something before that confidence really starts to build. And then so we took a look at materials, we took a look at energy, we took a look at industrials as well. And then the last one we got to take a look at is finance. And the finance weekly chart, little bit of fade action, has yet to confirm. And the thing you got to be looking at here in finance, because finance could be an area to start picking up. Unlike some of these other cyclical areas of the market, guess what finance didn't do? Finance didn't break up above those moving averages. Finance got carried a little bit today. Finance got carried into those moving averages. And so I do think, unlike some of the confirmation we're seeing in energy, unlike some of the confirmation we're seeing in some of the other areas of the cyclical markets, finance still has work to do, because I feel like finance is being carried by the market today and not being a leader in the market today. So that's one of the reasons you haven't broken through those moving averages. It's lagging a little bit of the price action. That's got to be a slight concern in finance specifically. And then the cyclical areas, we're still navigating that the recovery and consumer staples, but we're back to the breakout channel. And obviously, I mean, a lot of technicians are going to finish my thoughts here. What do we wait for after a 4-day movement that goes from 70 to 73 in consumer staples? We wait for a high base and a breakout, right? You're overextended here in the recovery. High base scenario really makes a lot of sense. Consolidate, place some defense up at the higher price. That's what we want to see in consumer staples. We want to see this price threshold that has been achieved over the last 4 days. We want to see those buyers hold. You don't want to see those buyers who have made money in the last 4 days. You don't want to see them capitulate just simply due to recovery analysis. You don't want to see them be like, well, I held through the volatility. I achieved break even. Now let me just get the hell out. You don't want to see that. You want to see it a defensive nature, the buyers holding the line, and that's the high base. The high base is simple consolidation where you're waiting for that next trigger. What it really does is it builds confidence in the traders who have missed out a little bit on this recovery in their back of their minds, saying, oh, you got to achieve something next, right? You got to achieve something next. Well, that something next is going to be a little bit of defense as those moving averages catch up. A flag-based pattern makes some sense here as well, but keep an eye on it. You got to like the recovery here. But again, we're talking consumer staples and we're talking a 4-day recovery. And I want you to think about this for a second. It took 5 days for it to go down. It took 4 days for it to go right back up. The bulls are thirsty, okay? Let's see them play some defense now, though. Let's see them play some defense. A little too hot in the consumer staples area. Utilities broke out yesterday, a little bit of confirmation. I don't see any trading, just people that invest in utilities. You're like, finally, breakout, let's go. But I don't see it's utilities. We don't really track utilities from an active trading perspective. Real estate, however, we do. And we talked about the potential breakout yesterday in real estate reclaiming that previous channel and then breaking up above all the clear air here. I do think real estate is going to be in the spotlight for a lot of traders over the next couple weeks as we navigate a little bit of as the volatility does subside. We start to see where the money's really kind of driving. Real estate looks very thirsty right now, and it's breaking out against an all-time high. So that's got to be a positive sign. And then when you're looking at the last sector, we looked at staples, we looked at utilities, we looked at real estate. Let's take a last look at healthcare. And I got a very similar take on healthcare as I do on finance, with the cyclical areas kind of lagging behind some of the price movement. Was finance against industrials, against materials. Well, when you're looking at healthcare in the defensive area, I think you got to have the same philosophy. It's being carried a little bit here. It's up 1%. The market's up well more than that. It's being carried by the market, and we haven't yet broken out of anything. We haven't really even broken any pattern here. Looks like a choppy mess because it is a choppy mess. Wouldn't really be spotlighting healthcare right now until we see a little bit more consistency. And for me, that starts at 135.
Awesome. Love it. Now, before we get into commodities, I do want to promote the podcast that you and Coach Tyler did yesterday on volatility. So make sure you guys grab the podcast. Why don't you tell us a little bit about the podcast and what you guys talked about?
Well, that was Tim. Coach Tim did the interview with Tyler, and I've yet to actually have a chance to listen to it. But I always do look forward to listening to Tyler's thoughts. Yeah, Tim did that, so definitely check it out. I did the Market Skyline portion of the podcast yesterday, and honestly, it was very similar to the Skyline I did for the halftime report. So it's almost like not a lot of things had transpired between when I did the halftime report at 10:30 and the podcast at 12:30. So a lot of similar commentary on the podcast this week as the halftime report, but hopefully you guys do enjoy it. And if you like the podcast, best way to support the Trading Justice podcast is those 5-star reviews on iTunes. Helps us compete with the big dog podcast out there.
Well, the link is in the chat there in YouTube if you want to grab that podcast. Let's get into the commodities. We want to look at first gold or oil?
Well, I can take a look at gold very quickly. There's not a lot to see here. It's holding the ground, 1760. Great year, 1760. It's holding, but there's really nothing to see here. Right. I mean, again, it's a positive thing for gold owners that it's holding support, but I'm not sure gold owners would care if it broke support. I know as a gold owner, I don't care if it breaks support because if it goes down to 1720, I think you got a better buying opportunity. And so I don't think traders in the gold market really care about this right now because a lot of traders don't trade actual gold itself. They'll trade proxies to gold, like the miners. Kind of same thing with Bitcoin, right? You got people that trade Bitcoin, and then you got people that trade Bitcoin miners. Well, I think most people would trade more gold miners than actual gold. Gold is more of a position style trade. Gold is a wonderful investment. Gold is wonderful to write covered calls on, those types of things. And so I don't see any trade here in gold, and it's just kind of a choppy mess trying to fight against the cluster of seemingly every moving average, not named the 20-period moving average. That should tell you about the volatility and the price level over the course of the last couple of weeks. So my perspective on gold is really nothing to see here. Oil, a little bit of a different beast here, a little bit of a different beast. Technically, you're still looking at a bearish retracement. However, what we said yesterday was you got to keep an eye on 70, right? Because again, you got to be accurate in your technical analysis, and this still is a bearish retracement that has yet to test a falling 20-period moving average. But there's other context that is happening in the oil market that kind of created the volatility of the technical pattern in the first place. And I think that context is important. And so yesterday we talked about oil, and really kind of the first step in the recovery was really either a double bottom or the reclaiming of the 200-day moving average, which is right there where the 9 EMA is. We've done that as market participants. Oil, the resistance level of 70 was reclaimed. I still believe, however, from a technical perspective, we're still kind of in wait and see mode from a short-term trading perspective. And so the short-term traders, I think, are going to be waiting, and I can only speak to from a technical perspective, are going to be waiting for what Coach Frank would dub bear stop out day, right? And I don't think bear stop out day is the retracement at 70. I actually think bear stop out day is the 20-period moving average right there where the volatility began, and that's at 75. And so when you're looking at the reclaiming of 70, I think that's a good step. However, it still is a bearish retracement. You're still fighting the volatility of the downward movement in price. That changes if we reclaim 75. And so from a short-term swing trading perspective, I think it's very compelling. I think it's very interesting. And it's certainly something that we need to track from a short-term trading perspective. But I think we still got work to do here. I still think we got work to do. And that work to do for me starts at the 20-period moving average at this point.
I agree.
Now, energy stocks, that's a different conversation altogether. But for crude oil, any trade has to be on. You have to have a bullish trend. You have to. I'm sorry. I know this might sound shocking to some people, but for a bullish trader, they do prefer bullish trends. I'm just throwing it out there. Just throwing it out there. We haven't seen bear stop out day, but again, compelling evidence, compelling opportunity. But again, it's one of those scenarios where deep pullback, I think you can be a little patient as it fights up against some of this resistance chop.
I agree. All right, let's take a look at what's next. Dollar, Bitcoin.
Well, we can take a look at the dollar.
I do have one.
We took a look at the dollar.
I have one more I'm going to give to you today to look at, but go ahead and talk about the dollar.
Dollar looking at a bullish uptrend. Dollar has increasing momentum, but the fading action over the last few days is not interesting to me at all. That's all I literally have to say on the dollar. Like, it's the most boring financial instrument to me. Cody, who is doing his own thing right now, but he certainly will be back with tackle trading, and you guys will enjoy some of his Forex stuff. But he keeps telling me, Matt, come back to the dollar, come back to currency, come back to Forex. And I'm like, oh no, no desire.
Well, moving on from the dollar, I guess when Cody comes back, maybe he can talk to us.
I'll let him give a thorough review on all things currency related.
And then we will all go on break to go fill up our coffee while he's there.
Yes. That is how currency works these days.
All right, let's look at Bitcoin.
Bitcoin here, 200-day moving average, going to have a very similar take on it as I do oil, quite frankly. You got to like, and again, I said yesterday, if you looked at this as a gap down, I understand it, but I see this kind of as the exact same price action with the clip of 55,000. I do think it's very compelling at the 200-day moving average. It does have some evidence, but that evidence is very choppy. I think it's got some work to do. And again, when it's in a better technical environment, we'll be ready to trigger, and we'll talk about it openly on the halftime report. But as of right now, you're still seeing this as a short-term bearish downtrend. You're still seeing this as it's got to have work. It's got to put in a little bit of work. Volatility has to subside a little bit. I think you got a very similar take on Bitcoin as you do crude oil right now, quite frankly.
Appreciate that. Now, there is one more I need you to analyze for me, because I'm trying to wrap my head around this. I can't even say it with a straight face. Why is the VIX down?
Softball.
I'm trying to get through. I'm trying to get through without
Hold on, Em. Hold on. Queen, my queen, hold on. Let me find my sword. Hold on. I kid. That gets my head chopped off. I threatened the queen. But the queen had her dude analyze the VIX. The VIX is down. How do I say the VIX is down without saying the market's up? I don't think you can. The VIX is down because the market's up.
Yes. Thank you. I appreciate
I'll let others wax poetically on the VIX today and how this represents a massive buying opportunity and a subsiding of volatility and all that. I'll let them handle that one.
It is a slow news day, Team Tackle, so we're just having fun here with the VIX. But I do want to talk about the lovely webinar you had yesterday on covered calls.
It was fun.
Tell us about that.
If you have not had a chance to check out the covered call tackle trading 101 covered call, a beginner's guide to covered calls from yesterday. That was a mouthful. Definitely check that out on our YouTube channel. I'm sure it's in our Tackle Today, which is the blog we post on all things happening in tackle trading every single day. Check that out as well. But we had a lot of fun. I went through a journey around covered calls, what they are, why we do them, what is the structure of a covered call, the rules
Mhm.
towards a covered call. Went through the foundation of a covered call, talked about we did some case studies. Actually, MGM was the case study, pulled it from the Tackle 25. And I thought we had a lot of fun. At least I did. It's hard on YouTube because as an educator, a lot of times you feed off the energy of your crowd,
Yeah.
right? And I've taught in a lot of rooms around the world that I feed off the energy of the crowd a lot. In
Mhm.
YouTube, like literally, you're just like your audience is there, and you want to teach to them,
Yeah.
but like my style is I ask a lot of questions. That's kind of my
Uh-huh.
style,
Yeah.
and doesn't really work great on YouTube. But we had a great time. At least I think we had a great time yesterday on YouTube.
I believe word on the street is that it was a wonderful
Word on the
webinar.
street. Word on the street was it was a wonderful webinar. So I was there, but I can't tell you who else was there.
Well, if you missed it, the link is also in the chat. So go ahead and grab that and watch that webinar. It was great,
I
which
honestly, if you are new to the world of investing and if you're new to covered calls in general, I would strongly encourage you to go watch that webinar. I wanted to go through I wanted to talk about the why we do things. I wanted to
Mhm.
talk about the rules and the structure, but really focus on the understanding of why. Right.
Mhm.
And so I'm pretty certain it was a good webinar. So definitely check it out.
Absolutely, which is going to take us right
That's
into
like asking a chef if they enjoyed the food. Like, I hope. I know I did. Like, did you enjoy the food? So,
it was well enjoyed. It was well enjoyed,
yeah.
which takes us right into the next segment of halftime report. We're going to get into Queen's Court, and I've got a two-part for you on Queen's Court. One,
Oh, nice.
I want to recap last week's Queen's Court because that was on covered calls.
Well,
And
and just to set it up, because we might
uh,
have new people here, right? Just set up. Queen's Court is a segment we do on the halftime report where my queen, Coach Emily, can ask me whatever she wants. And I, as her counselor, will give her advice on things that she can do. And if she likes what I have to say, she'll take some action on it. And if she doesn't, she'll chop Tim's head off.
that's pretty much how it
That's
goes.
how it works.
That's exactly how it goes. And your words of wisdom, your words of wisdom are greatly appreciated, and definitely always put them into consideration whenever I am looking into getting into new trades.
Mm-hmm.
Last week, however, when I came to you for Queen's Court,
You should have waited on me for Apple.
I should have waited.
Mm-hmm.
I should have waited. So we analyzed two stocks. Actually, we did three. First one was Apple, and we looked at Apple getting into a covered call situation with Apple
Mm-hmm.
and selling either a 165, 167 and a half call against that. And
Yeah.
by the time I had come to you for the advice, the trade was already in. And your perspective was just buy the shares and let it run because you could see the potential of it just breaking out, which, ta-da, what has happened?
Well, I saw strength in Apple, right? Increasing momentum in Apple. Apple was bucking the trend of the marketplace.
Mhm.
And when Apple wants to run, I just have a philosophy that I don't try to fight it. It's really simple. It's really simple. But I can understand why somebody would have wrote a covered call. I mean, your Apple had some pretty decent price appreciation, forming a high
Mhm.
base. Problem is, high bases are momentum patterns that when they get violated, you see an increasing momentum condition typically.
So,
And so I just felt like the technical parameters were better fitting for an open-ended risk graph than a lockdown one.
so now I got a management question.
Yeah, you do. Yeah, you do.
Do I let them take the shares away from me or do I manage my way out of the call?
Well, for me, it really depends on what the structure of the trade was to begin with. If Apple is an investment, number one, you probably should have wrote a little bit deeper of a delta contract, like I talked about yesterday in the webinar, because I did spend some time yesterday talking about the range of the delta we sell.
Yeah.
Depending on how aggressive you want to lock down that risk graph, and in a environment that the market has been in over the last couple of weeks, I could see a lot of traders coming in and wanting to lock down risk graphs. But with Apple, I just had a different perspective. That was all. And so when you're looking at it now, you got to make decisions based on current price action. You can't go back into the well and say, you know what, this is what we should have done last week. Well, what we should have done last week doesn't help us today. We can learn from it, right? We can learn from it. Maybe the next time we see Apple in a high base environment with increasing trend momentum, we don't write a covered call, but that's not today, right? That's not today. Today is we wrote the 167.5 call option and the current price is at 170.88. You are absolutely threatened to get this pulled from you. There's no doubt about that. And mind you, I'm saying this like I'm sure there's people hearing this as a negative. That's max return. That's not a bad thing. That is not a bad thing. You sold the call option on Apple. You own the shares. You're going to deliver them at 167.5. You bought them at 160. You bought them at 155. Whatever the case might be, that's a positive thing. You got to keep the cash flow and the call option received. And so if you were going into this as with the trader's mindset and saying, I don't care where Apple goes, I'm willing to sell it at 167.5. Well, if Apple's at 170 or 175, that shouldn't change that. The greed that we have as human beings shouldn't change the logical choice that you made last week when you sold this call option at 167.5. Does that make sense?
Yep.
It's too easy for traders to chase current price action when the decision you made last week was a logical one. I'm selling the 167.5. I'm willing to let this get pulled from me, but now the price action at 170, you're like, what if it goes to 180? Right? I get it, but we got to make decisions based on the structure of the trade, right? And so if this was a trade, I would just allow the shares to be taken from me. That's the agreement I made. That's what I structured the trade as. And the price action today should not change that. Does that make sense?
Makes sense. What if it was an investment?
But if it was an investment, I have a vastly different take on this. If it is an investment where you don't want the shares to be pulled from you, there's things, and again, the would haves and could haves and should haves of the world, we could have went back and adjusted that delta that we were selling, maybe sell it against, instead of right up against the high base, maybe sell it at 172.5, maybe even take it a little bit further out of the money so that you don't get threatened, right? That's a decision that we make in the real time. That's not a decision for today. The decision for today is about management. And the management on the top side, when it comes to covered calls, you have two decisions you have to make as a management decision. The first one is always to the downside, okay? Yep. To the downside is really easy. It's always about net liquidation. You receive $100, the market goes down, the value of the option is going down based on delta on theta. It's losing 40 cents to the dollar. Every time it goes down a dollar, all of a sudden that $100 is now worth $20. You buy it back and you immediately write a new one. The management to the downside is relatively simple, and that's why a lot of investors who do cover calls do not, and I know this might be crazy to think about as new traders, they don't care if their stock goes down because it makes the management of the covered call that much easier, and it also allows them to compound at a cheaper price, which investors love compounding at cheaper prices. And so they don't necessarily care if it goes down because of those two dynamics. But to the top side, we will fret over that decision when that decision should be based on what I would say a little bit of math. And so when you're looking at just help me out real quick. What was the expiration date you were working in them?
The expiration date was December 31st. December 31st. So the 24 days now.
So 24 days now. And it was the 167.5 call option, right? Okay. So the 167, right there. Okay. So the 167.5 call option right now is about, what is that? About $3 in the money right now. So you're about $3.42 in the money. Now, very simply, it's very easy to understand. You see these two values here, intrinsic versus extrinsic. Okay, right now, the value of your option is right around $7, give or take, depending on the bid-ask spread.
Yep.
Okay, now, of that $7, $3.42 is what we would consider intrinsic value. Okay, $3.65 is what is called extrinsic value. Now, if the contract's exercised, the extrinsic value goes to zero. The buyer of your option is willing to give up the $3.61 to make the $3.46 of intrinsic value. Nobody would do that. Okay. Nobody's going to exercise the right and pay more money to get into the position. They're not going to give up $3.63 to make $3.42. Not going to happen. Okay. But when the intrinsic value goes up against the extrinsic value, that decision can't be logically made. Now, it doesn't mean your option is going to be taken from you the moment that happens. That's not what it means. It means it can logically occur, right? And so when you're looking at this, you're in that zone where you have a decision to make. And that decision is very simply this. Do you want to roll that contract up and out, okay? Or do you want to leave that open-ended and take the risk to the downside of a fake out with Apple's breakout? That's the question. And unlike the mathematical equation to the downside, where it's really simple, right? It's really simple. If you receive $1, that's called $1 of net liquidation value, right? If that dollar gets liquidated down to 50 cents in the first week of the contract, you're out. You're taking your 50 cents and you're running, okay? Because it's money now. You have now. It doesn't make a lot of sense to wait another 3 weeks to capture the other 50 cents when you captured 50% of it in the first week, right? So that's an easy decision to make. If it's 3 weeks and you've captured 80% of that net liquidation, that's cash in hand, right? That's cash in hand. And so that decision is just made based on math. When you capture X percentage of the net liquidation, typically cash flow traders will just pull the trade. They actually don't wait till expiration a lot. That's only for a lot of new traders, because to new traders, we're not ready to talk about the risk to gamma in the last week, right? But to veteran traders, we are. And so for new traders, just understand, we don't hold a lot of these trades into expiration. We're going to really base a lot of this on net liquidation value. But to the upside, you have a decision to make. And that decision is not based on this mathematical equation. It's not easy because it's subjective. It's a decision that only you, the trader, can make. And that question is, because you could absolutely, as an investor, you absolutely could get Apple pulled from you. And if you're an investor, we might want to sell a deeper delta. Okay. But that doesn't change the fact that we have that decision to make today. So the question I have for you to help me give you the best advice I can is, where do you see Apple going from a technical perspective?
I don't know. It's at an all-time high, right? So what I would want for Apple to do was to kind of sit here and high, maybe even have a pullback.
Nobody cares what you want.
Well,
I care about your hopes, wants, and dreams, Em. I care about you as a human being. But as a market participant, nobody cares. You want Apple to come down under 167 and a half.
I see Apple continuing in this momentum. And just
I do too. I do too. The simple reality is it held up against the volatility where not even Microsoft did that. It held up against the volatility. Number two, it's a leader today.
Yep.
It's a leader today.
It was a leader last week when everything was crashing.
This isn't being carried by the market today.
Yeah.
Apple's leader in the market today. Apple is the dam. Okay. It's the thing that's holding everything. And so when you're talking about Apple here today on a multiple time frame perspective, you got to like the fact that it's breaking back up above these resistance channels. It's not clean, but I would call the resistance channel at 165. And so you're breaking up against those resistance channels. You got to gap up and you got to run up, and you're breaking out of that previous area of resistance. And the simple reality is I did a webinar 2.5 weeks ago on swing trading.
Mhm.
And I'm willing to bet Jesse Livermore would buy Apple right now. Now, he can't. He died in like 1941. But if he could, you buy breakouts against all-time highs. You just do it. Because when you said, this is an all-time high, I'm like, yeah, Apple's had 1,000 of them in the last 10 years, right? You never fight the trend, okay? And so I don't think we should compound what I would describe as a little bit aggressive covered call here on Apple. And that compounding would be to roll it up and out and to maintain the structure of the trade, when I feel like we may have been a little aggressive in writing that call on Apple in the first place. And so I feel like to correct that mistake is just to simply take the loss on the call. So my advice, and again, you can take my advice, you don't have to. That's what the queen does, right? I give my advice. You tell me if you like it or not.
Okay.
My advice is, in this choppy environment, is to leave this uncovered anything above 165. You take the $5 risk to the downside. If it comes underneath 165, you recover.
Appreciate that. I will put that into consideration, being that I didn't on the other one. I might put this one into consideration. Actually, as a matter of fact, I will put it into consideration now. The other one that we talked about.
I'll give you 15 seconds to adjust that trade.
Done. Let's talk about the one that is.
I like plans, Sam. I like plans. When you have a plan, it's easy to follow. If it stays above 165 in the current environment, you have some degree of bullish trend with confirmation on a breakout. If it comes underneath 165, that bullish breakout dynamic changes, and at that point, you're talking a little bit of choppy neutrality. At that point, I think it's perfectly fine to write that cover call again.
Perfect. Appreciate that. So
can I just say one thing? One of the most important things we traders can learn is to take the L.
I know, right? It's so hard to take the L.
Even when you're making money on the exit. Think about that for a second, Em. What I'm recommending is you just take the gain, because you've actually made more money on Apple than you lost on the call option. On the call option, you've lost about 40%. On Apple, you've gained 100%. You've made 60 cents per every $1 movement. Just take the L.
Okay. Jeez, gotta keep pounding.
It's amazing. It's amazing. I'm trying to recommend Emily to take an L on a winning position. You guys, traders are crazy.
No, we are a little crazy. We are
Traders are crazy.
All right, so here's the other one we analyzed last week. So now this one I actually didn't cover, which was what my analysis was in the first place. Let's take a look at AMAT, a Tackle 25 stock. And AMAT,
I do believe my advice last week was to leave it uncovered.
Yeah, and that was my initial approach too. So we agreed on that one. We didn't agree on Apple. Or rather, I didn't take your advice on Apple.
You didn't ask me on Apple. I'm slightly offended at this. I kid. We're having some fun, Tackle.
We're having some fun. So AMAT is, and I was looking to cover AMAT when it got to, obviously that all-time high over there at 159.
That was the plan, is to reassess at 159.
Exactly. So we're getting there. We're approaching it. We have a very, very nice candle today. It's up 7% on a day. Should my analysis change, or should I just kind of still keep it there and see what happens?
I think it does change a little bit. I do think it does change a little bit. And I guess for me, Em, on this one, the plan was to originally reassess at 168, 169 as we start to navigate that all-time high breakout, right? You got a lot of momentum in Applied Materials over the last couple trading days. The market's building momentum, Applied's building more. The market's breaking out, Applied's building more.
Yes.
And so you got to like the fact that it's kind of a leader here. It's leading the hit parade to a certain extent. and you got a no sell day candle so far. And I think that's impressive as well.
Mhm.
Again, we've talked about this in other areas of the market. You got to show me you can hold your breath above that level, right?
Yep.
And there's no sell here so far. And so when you're looking at this from an intraday perspective over the build over the last couple trading days, look at the market just pounding the table here in the morning. Look at that cash open. And then you know what everybody else did an hour later? Like, yeah, we're
Ooh,
good.
look at that.
We're good. We'll keep buying. We'll keep buying. We got confidence. We got confidence. And so the confidence is building here. It's reclaiming all the moving averages, which obviously was going to happen if we were going to make that decision at 158 by 159. And so
Mhm.
we're out there, but I kind of have this feeling that we should allow applied a moment,
Yeah.
right? Just not a lot, but we should give it a moment to attempt this breakout and to see something above this if it can do it, because applied can fly.
Mhm.
Applied can fly. And so when you're looking at a potential breakout here on applied, here's the last time we broke out of resistance level. It went from 142 to 159 in about a week and a half, 2 weeks. That's going to puncture any contract you've sold on applied materials. And so
Right.
I think you want to give it a little bit of time. Here's the breakout last time. Applied went on that breakout. Applied went from the 123 to about 145, went up about 22 points before it consolidated. It came back down. Don't know if you want to fight a cover call in that type of momentum. Look at applied on this breakout. Didn't achieve this same momentum, but that was a pop and run that would have violated. Look at that breakout. That's a pop and run.
Mhm.
Applied's got rich history. And so I do think we give applied, and guys, this isn't even the best trending environment for applied materials. Applied materials has that in it, right? That in it, very consistent. That's why we love applied materials. And so for me, applied materials is in an environment where I think you want to give the combination of the daily momentum and the weekly channel an opportunity to break out here.
Okay.
And so I don't think the analysis changes that much. For example, if over the next 3-4 trading days, we start to see a little bit of consolidation, maybe a pullback, maybe you reassess and throw something a little bit deeper out of the money on a covered call and applied. But I do think you want to give it a little bit of breathing room just to see if this momentum can continue, because a breakout here on applied materials would be multiple time frame based. Weekly breakout, daily breakout, looking pretty healthy on a really, really good company that doesn't have the same valuation concerns that a lot in this space have. And so I again, when in doubt, cover, right? I mean, that's kind of the general rule. When in doubt, cover. But I think giving applied a little bit of room to breathe, give applied a little bit of opportunity to break out here, because again, you're playing with gains here, right?
Yep.
You're playing with gains. You gobble that support. Now you're setting at resistance. You're playing with gains. I think you can play a little bit of time with that. And so I would say give it a couple days, let this breakout, give applied a little bit of room to breathe on this breakout.
Awesome, awesome, awesome. Thank you very much for that analysis. Now, that was just a recap of last week's Queen Squad. I got a Queen Squad for you for today.
Oh, sweet. I thought I was done. Let's go.
Yeah, it's going to be a quick one because it's just going to be a would you rather game. You like playing?
And I do love Would You Rather. And guys, ladies and gentlemen, I was doing that last night too.
I didn't even know you did that.
Oh, I was doing it all night last night. Like I was like, hey guys, wait a second, hold on. I don't even know if I can just say guys. Ladies and gentlemen, like I started acting like that. But do you like how me and Em are structuring Queen's Court here, where Emily comes to me and I give her some advice and we really kind of go through the detail? Because sometimes, Em, and I'm not kidding, sometimes I forget you and I are even on YouTube and it's just you and I talking. Like, I'm not kidding. Like sometimes I like
right?
me and the Queen doing our thing. So I hope you guys enjoy kind of had the structure of Queen's Court, because sometimes I do forget there's an audience here. Okay, now we're gonna play Would You Rather. I love Would You Rather. Let's do it. Let's do it.
So I'm updating my watch list, and I'm looking at the industrials, and you did a wonderful job, going through all the sector updates and all that stuff. So I'm eyeing industrials as it starts to kind of, make its recovery back up, right? And I'm looking at these two particular companies, Lockheed Martin and Northrop Grumman. They're very similar in what they do in the
You
industrial.
want aerospace.
Want some
You want
aerospace.
aerospace. Okay.
And
Okay.
I'm looking at them and I'm going, they almost look, kind of like how Home Depot and Lowe's go together, Walmart, Target go together in most cases, right? UPS and FedEx type, stuff, right? So we've got two similar stocks, literally identical. And I'm having a hard time picking because they're approaching, the 50-day moving average. There's nothing to trade here until we break above those moving averages for me. But I'm putting them on my watch list, looking at them, analyzing them, on whichever one triggers, whichever one I pick, I want to be able to make, pick one. I don't want to trade both, but I want to pick one. So I'm looking at
Are
these
you
going,
looking directional?
of course.
Okay. Greedy trader. I love it. Okay. So you're looking directional. And are you looking swing or position or investment?
Position.
Position. Okay, because that does help. Because if it was the swing trade, I'd say knock. I'd say knock, and the reason being, knock has a little bit more strength than Lockheed Martin does. The sell off on Lockheed was a little bit more prolonged, had a little bit more prolonged bearish downtrend. You're talking about Lockheed at the ultimate lows here, and it's a choppy reversal on Lockheed. It's a choppy reversal a little bit on knock as well. But there's been a lot of chop in the market over the last couple trading days.
Yep.
The question I have in general is why aerospace and defense?
It's just an area of the market that I don't have exposure to.
Mm-hmm.
I was just looking at this pattern and going, they are both lagging, right? They're trying to play
Mm-hmm.
catch up. And I'm looking at this going, if they break above those moving averages, especially the 50, there's a nice little run up to those all-time highs, right? So that's why I'm thinking position. I'm not in a rush for it to get there tomorrow or next week. I'm just looking at if the industrial sector starts to inch up, this is a lagging area of the market that could play catch up and might have potential.
Well, I do think you can definitely look at a potential breakout against a right shoulder above 167 and a half, 168. I don't think you could legitimately target anything above 380 though here on knock. And
Mhm.
so you're really only dealing with about a 13-point window on a position trade, which honestly I can find swing trades that get you that right now.
Mhm.
So I don't see the potential there. I mean, 400 secondary target, maybe. But again, there's so much history at 380 on knock. And I do like that trigger. Obviously the 50-day moving average acting as support that coincides very nicely with the 200-day moving average on the daily perspective. So I definitely see it, Em. I got to question a little bit that potential target for the return and the amount of time it would take to capture 13 points. Because again, there's companies today that are doing that today, and it might take 3 weeks for knock to do it type thing. It's kind of one of those slow moving beasts to a certain extent. When you're
Mhm.
looking at Lockheed here, Lockheed a little bit towards the low prices to a certain extent. You're feeling like a little bit of a double bottom. 320 is kind of that ultimate intermediate low price that you're acting as a support level. Currently, the price action right around 340. When you look at this on a daily chart, you're looking at a little bit of a wicked W type formation. So you're not getting in this in the pattern. You got to kind of wait for it to break out of the pattern and to reclaim that 347. That also reclaims the 50-day moving average. And I do think it gets a little bit clear here once you break out, but I also don't think you can target anything above that kind of 355 to
Yep.
360 area. And then when you take a look at the aerospace and defense uh, industry in general, you're going to see a lot of mixed results here. You're going to see a lot of mixed charts, some bullish, some choppy, some bearish. There's
Mhm.
not a united theme in the aerospace that kind of beat to their own drum right now. And so, for example, when you're looking at Raytheon here, a little bit of a choppy snapback, bearish retracement. Boeing's looking like a little bit of bear stop out day as it tries to
Mhm.
reclaim that 210 level. We were just taking a look at Lockheed. We were just taking a look at Knox. GD.com is or General Dynamics, a little bit of a choppy, overextended retracement. L3 Harris, bearish retracement, really fighting up against the 200-day moving average. I'm not seeing anything, quite frankly, that really stands out to me. And
Okay.
so it's really just about the stock itself. And that's not necessarily a bad thing. But when you take a look at why a stock goes up or why a stock goes down, the rising tide theory is important to me. And as a top-down analyst, understanding markets, sectors, industries, and then individual components of those industries is important to me. And so I just feel like we're fighting too much on Northrop, and I think we're fighting against too much on Lockheed. And I feel like this space itself is not a very consistent or easy space from a short-term or a short-term trading perspective or from a cash flow perspective. It can get there and it can be a beautiful environment when it wants to be a little bit more consistent, but it hasn't been consistent for a long time now. And so it's not just this previous volatility shift or the delta volatility shift. These charts have been really mixed for quite a long time now. And so if you're looking to take advantage of the industrial movement here today, and aerospace just kind of stood out to you a little bit because you didn't have it in your portfolio, I think we're maybe trying to press it a little too much here because we're not seeing a clear environment. We're not seeing a united environment. There's no theme that really supports in general the sector or the industry right now. And so you're looking still at some degree of neutral rating in the sector. If you were to rank every industry group, I would put this at a middling industry group within the industrial space in general without a lot of consistency in price action. And so there's a couple knocks, all pun intended, on the knock list. But if you're looking for some industrial components, maybe I might have a couple for you.
Okay.
Okay. So in a would you rather, I choose neither. And let me try to sell you instead on, yes, it's industrials. And yes, I'm going to say it.
Had to go railroads.
How do you win Monopoly? You buy the railroads. That's what you do. Look at CNI confirming here today. You got a consistent pattern. What is it? Big upward movement in price, retraces to the 9 EMA on the weekly, confirmation, then look to run again. I like Canada in general, but I like their railroad. I like Canadian National Railroad here on a position. You did ask for a position trade. I gave you a beautiful weekly chart there. You might already have it though, Em. So that's
Actually,
one.
I was going through the sectors, and then I didn't get to the railroads. I was thinking more,
Listen, you knew you were going to talk to me, and in the back of your head, you're like, Matt's going to hate aerospace and defense. He's going to try to sell me on railroads anyways. Yes, I am. I am going to try to sell you on a little bit of railroad here. All right, so CNI's one, and I do like the weekly perspective position analysis. And then
your other would you rather
look at
than
the double bottom there. I like that one. Do you like, let me ask you, do you like trucks?
Of course.
Do you like a truck?
I love trucks.
Do you like freight trucks?
Mm-hmm.
You like big old Mack trucks?
I got a lot of friends that drive these big old.
I got Old Dominion Freight Line here on a consolidation. I don't want to call it a high base. Too much time has passed. A little bit of neutral action, but it's clean above 360, and a close would see a nice confirmation against 363 and a half. I like trucks too, Em. Here's you got a consolidated neutral breakout on Old Dominion, and you know what you like knock. Well, I'm going to bring you Rockwell Nation here. Rockwell Nation fighting the volatility and breaking out here today, breaking out of that 350 handle. And so I don't love the aerospace and defense industry in general. It's kind of a choppy mess right now, and it doesn't have unified themes. Everything kind of beats to its own drum right now. I do like the railroads solidifying themselves on those weekly charts. I like the freight trucks in industry with Old Dominion, and I'd like Rockwell Nation here because I'd like breakouts on Rockwell.
I
I know.
kind of like that railroad chart.
I know you do. Coach Emily says to win Monopoly, you just buy railroads. That's the headline.
That's it.
That's it.
Well,
so we got CNI. You like the position on CNI?
yeah, I'm like, rock who? I can't even hear you. Knock who? I can't hear knock. They're
You're
back
just looking at
communications where we can't hear them anymore. I can't hear.
I can't see you. I can't hear you. You don't exist. What exists is CNI. I like that position on CNI as well.
This is why we love our community here at Taco Trading, because guess what? I don't have to go with the trade that I had. I can always pick up somebody else's list, because you know what? Trading is a team sport as well, you know?
It certainly can be.
Love what you see. Make sure you check us out here. We're here every single day. The markets are open Monday through Friday. If you love what you see, you can also check us out at Taco Trading. I'm going to put the link in the chat there. Go ahead and give us a 15-day trial. And if you are Team Tackle, you know we adore you guys. So go ahead and give us a like and a share. And I don't have anything else, but that was a wonderful Queen's Court. Thank you for the update on the covered calls. Thank you for, you didn't have to twist my arm on LMT and knock. That was like a forget that. I don't know who they exist. They don't even exist in my list anymore. Who are they? Who are those?
Get them off that watch list. Get them off that watch list.
They are off my list. They weren't even on the list. They were potentially trying to get on the list, and they didn't even make it.
They were creeping. They were creeping up on M.
Yeah, it's like they were trying to get in the club, and you were the bouncer at the door, and you're like, no, you're not getting in.
You're not the quality that we're looking for.
There are better people in here. Get out of here. You're not going in.
Not the droids we're looking for, Emily.
Absolutely. All right, guys. Programming wise, we have tonight at 7 p.m. Dynasty Labs Investors. We are meeting back on our Tuesday schedule at 7 p.m., followed by the Coaches Show at 8:30 p.m. So we will see you guys there. And if you are new to Team Tackle and are wondering what we are all about, you can schedule a consultation and chat with either myself or Coach Tim, and we can walk you through all things that we do here at Tackle Trading. We also have our sale going on through the end of the year. So go ahead and get re-upped on all your pro membership, get those premium products that are on sale, get your education going right for 2022. I'm dropping all those links in the chat there. So if you guys need anything from us, we are here to help you and guide you guys and get your 2022 off right. Matt, thank you very much as always.
I feel like you and I had a coaching session. I feel good about this. I feel good about this. I haven't coached for a long time. I was like,
I know.
Coaching hat on. Let's go.
Yeah.
Let's do this.
Always fun.
Yeah.
Always fun.
I rather enjoyed Queen's Court today. So thank you.
Thank you. All right, guys, we are out. We will see you tomorrow, same time, same channel.